Okay, so moving on. Let's do it graphically, right? So there's three ways to do everything. As we always say, we just did the numbers, we did the intuition, now I got the graph. So we've got our demand curve. Now, why is the marginal revenue curve less than the demand curve? I want you to think about it. If this was class, normally I'd teach this maybe over a week. So the second day I would ask students, why is it less? Well, because if you want to sell more by reducing the price, you reduce the price for everyone who's buying it, not just for the new person. We've got our marginal cost curve. I might say, why does this have this shape? Because of increasing returns followed by diminishing returns. So then I would say, where are they going to produce? Well, they produce where marginal revenue equals marginal cost. There we go. So you take this quantity here. Now, a lot of times students will want to go over here. They say, this is the price. No, the monopolist is going to charge as much as it possibly can, right? So it goes all the way up to the demand curve, and that is the price charged by monopolists. So, is this firm profitable? Well, we need to add the average total cost curve in. The first thing I would say is, does this look like it's in the right place? Yes, it does, right? Because it crosses, the marginal cost curve crosses the average total cost at the minimum, which it should. If the additional cost is less than the average, it brings down the average. If the additional cost is greater than the average, it brings up the average. And in fact, sometimes I like to ask students that when I first show this as well. I'd say, do marginal costs and average cost have the relationship that we would expect? Yes, because when marginal cost is less than the average, it brings it down. When it's greater than the average, it brings it up. We can even see that it crosses the average somewhere between 6 and 7. Okay, so there we go. So is this profitable? Well, the formula for profit is price minus average total cost times quantity. So you might have seen it when a little sneak peek here. There are going to be positive profits. There you go. Another thing students like to do is they like to just say this is the profits because they just get everything confused. Once we get to the monopoly graph, it gets very busy. So sometimes textbooks like the one you guys might use assume constant marginal cost. A constant marginal cost makes it a little simpler, so just be aware of that. But we've got normal marginal cost here, so there we go, the firm is profitable. So one thing that your book focuses on, which I think is helpful, is that there's no supply curve. So if you recall, firms operating in perfectly competitive markets determine how much output to produce based on price equals marginal cost. So a supply curve exists in perfectly competitive markets on the marginal cost curve. A monopolist market power implies that price is greater than marginal revenue, which is equal to marginal cost. Why do we say these are equal? That's the profit maximizing quantity. So price is going to be greater than this. So monopolist determines how much to produce based on marginal revenue, which is less than price. So a change in quantity will change market price. So there is no supply curve for a monopolist or a market served by firms, but there also kind of doesn't need to be, right? So if we're discussing a monopoly, we can just draw this. We can draw the firm demand curve and get all the information we need. All right, so the book talks about the importance of entry barriers. So I always ask students, what would you rather be, a perfectly competitive firm or a monopolist? The monopolist, right? So a perfectly competitive firm earns zero profit in the long run. A monopolist will earn positive profit as long as there are barriers to entry. So, in the presence of barriers to entry prevents other firms from entering the market to reap a portion of these profits. That's why they earn positive economic profits. They're going to continue over time as long as it maintains its market power. Monopoly power, however, does not guarantee profits. So let's look at a case here. So we've got marginal revenue, marginal cost. So the quantity is produced right here. Go up to the demand curve, there's our price. So the question is, are they earning profits? No, they are not, because price is equal to average total cost. Price minus average total cost is 0. So monopolist would earn 0 profits in this case. So one thing, I'm just going to go back to the entry barriers. There is a question like this on your homework. What's going to happen as other firms are able to enter? What's going to happen if we're talking a market demand curve, or I'm sorry, a firm, individual firm demand curve, the individual firm demand curve is going to go down. So I would pull my migraine medicine out of my purse, but you would not know what it means. But I have this other migraine medicine that's also $600. My insurance company loves me. And there's a patent on it, right? Someday that patent's going to expire. And when that patent expires, demand for Nurtec, which is what it's called, is going to go down, right? Because there's more close substitutes in the form of generics. So as soon as those barriers to entry go away, the market's going to change, profits are going to go down. All right, so the last thing we're covering in this chapter here is something called the deadweight loss. This is consumer and producer surplus that's lost due to the monopolist charging a price in excess of marginal cost. So there's a couple things going on here. Number one, the term deadweight loss, I don't know how many international students you guys teach. This is very confusing to international students. I used to have a bunch of Chinese students in our program, and I would write this word on the board and they'd look at each other like, what is she talking about, right? Like, think about this. A dead, like the word dead is in this. I finally asked a Taiwanese colleague to write the Chinese letters for it, and he said, please use the word efficiency loss. And I actually think that's a good practice to do anyway. This is an efficiency loss. The second thing, I don't believe I've taught you producer and consumer surplus. Producer and consumer surplus is basically, if you're a consumer, it's the price you're willing to pay if the price is lower than that. So like I just bought this sweater recently. I probably would be willing to pay $40 for it, and I paid $20. That's $20 of consumer surplus. Producer surplus is the difference between the what the firm would accept and what they get. So if like TJ Maxx would have accepted 10 and they get 20, that's $10 of producer surplus. Why am I telling you this? If this is something you teach, we're going to connect it to something you teach. However, I think there's a way to learn it without having to go through the surplus, that method. By the way, that's called welfare analysis whenever you talk about deadweight loss. So my other definition of deadweight loss is transactions that should occur that do not. So a transaction should occur when the price is greater than the marginal cost. If someone's willing to pay greater than the marginal cost of producing, that should happen, right? Like from a societal standpoint, that should happen. Now let's take a look at this. Any good for which price is greater than marginal cost, that's going to be this point here. So all of these goods should be produced. Price is greater than marginal cost. Yes, 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 yes. Monopolist is not going to produce these, right? The monopolist produces here and charges this price. So this, the book calls it PC and QC, that is the perfectly competitive equilibrium. If this market was perfectly competitive, this is how much would be produced. This is how much is. So this triangle right here is the deadweight loss. Okay, so it's transactions that should occur that do not. So there is a homework question where I ask you to calculate the deadweight loss. Please reach out if you don't know how to do that. But it's basically this triangle right here. So let's just go back. We've done it graphically. We've done it with intuition. Let's just look one more time at the math here. What does the deadweight loss look like in this example? The monopolist produces 6 and charges 120, but the 7th good should be produced and sold. The marginal cost of producing it is only $83.90, and the price is $110, right? So that one should, there's no reason that that should not be produced. So that is the deadweight loss. So it actually looks like loss transactions. And I just got distracted because I thought, I'm going to show them something. So I actually published a paper on this. So one thing, so we're deep into neoclassical economics, right? And a lot of times people are like, Adam Smith is like the face of neoclassical economics. If we're just thinking about efficient markets, Adam Smith likes them. Adam Smith was actually very critical of monopolies. And so you'll notice that this was under my maiden name. This is a long time ago. So I actually published this paper, Is Market Power Destructive? an undergraduate assignment using Adam Smith's critiques of monopolies. This paper describes an assignment where students evaluate a current industry using Adam Smith's arguments against monopoly power. Using Smith's arguments, students write a paper describing whether they believe a current industry, such as U.S. cellular phone industry, suffers from the problems he described in The Wealth of Nations. I actually usually had students choose Walmart for this, right? So if you think about, Adam Smith's dream, neoclassical economics, there'd be no regulation, right? We would just have firms doing what they want, consumers doing what they want. However, when there's no regulation, you're more likely to have monopoly power. And actually, Adam Smith really, really did not like monopoly power. He also didn't like externalities. So it's interesting. If he looks at something like Walmart, right, would he like it? And I believe it was about 50-50 back in the day. Some students were like, yeah, he'd like it. Look, there's low prices. The concern here for consumers is that prices are too high under a monopoly. But Walmart has lower prices. And I think half the class is like, you know what, Walmart's kind of using its market power to do some unfair practices, like treating its suppliers poorly or whatever. So it's pretty interesting. Monopoly is one thing. So if you think about like what Milton Friedman would have said in the 80s, he was a super conservative economist, like Reaganomics all the way. He would have said, you know what, regulation causes monopolies. Regulation is so bad that it causes monopolies. And the counterpoint would be like, no, we have to regulate monopolies. They're going to happen anyway. So that's a bit of a tangent, but you know what? One of you guys said you like my tangents. So you're welcome. That is it. We only have 2 lectures for this week. We're at the point in the semester where you know all of this stuff, right? We're just putting it together. So you're at a huge advantage if you've been doing well and following along. Next week, we're going to cover Monopolistic Competition, which is also in Chapter 8. Monopolistic competition is actually a really cool model and probably the most useful model in terms of real-world applicability. So we will be doing that, and let's see, this week we've got Jeff's presentation, and then next week will be Rachel's, and then that's it. Enjoy your day, and enjoy your week.